Thank you for joining our economic update video. My name is Dave Mantell. I'm a wealth advisor and partner with Stabler Wealth Management. For today's presentation, we'll review the fourth quarter of 2022, as well as provide an outlook for 2023 and the year ahead. Of course, given the environment that we're in, we have plenty of material to cover on today's session. Now, after a very strong 2021 in the markets, the first day of 2022 actually followed path, with the Dow up over 200 points that first day, notching in a record close. Unfortunately, from that point on, it was a really difficult year for investors throughout 2022. With the stock market falling nearly 20% for the year, the worst stock market year going back to 2008. In addition, nearly every asset class, including bonds, really struggled throughout the year, providing nowhere for investors to hide. While as investors, we understand that difficult markets are part of the investment experience, they are still uncomfortable to go through. And 2022 was an absolute roller coaster ride. And so moving forward, probably the best part about 2022 is it's now behind us, and we're able to turn the page to a new year in 2023. So in the coming presentation, we'll recap some of the events from 2022, as well as our outlook for 2023 going forward. Now, if we look back at why 2022 was such a challenging year, there is no shortage of headlines to point to, which really contributed to the big volatility. First of which was inflation. So from the start of the year, we saw massive inflation increases, the highest we'd seen since the 1970s, going as high as nearly 10% year-over-year inflation increase at the midpoint of the year. As a result, this contributed to rising interest rates, with the Fed trying to slow down the economy and get a handle on the high level of inflation that we saw. In addition, we started to see growth really tail off and slow, especially in the latter half of the year. And after a couple big years of monetary stimulus in response to COVID, 2022 was the first year where we saw a retraction of that response in a weakening of both stimulus measures. Cherry on the cake is we've experienced a lot of global unrest as of late. The most, kind of apparent of which is, of course, the Russia-Ukraine conflict, which continues on even nearly a year into it. And so again, this combination of headlines led to a very turbulent year across the markets. So as stated earlier, when you look at the equity markets, the end result was the worst market year going back to 2008. While with the S&P down nearly 20%, the NASDAQ was down 33% for the year, which of course is consisted primarily of technology stocks. And so in combination for all three of these major indexes, worst year going back to the Great Recession in 2008 into 2009. While, of course, the stock market had a very tough go of it in 2022, that was not the only asset class impacted. And bonds, which are traditionally viewed as a more safe haven, really struggled to a historic level in 2022 as well. And with interest rates rising at a very rapid pace, bond markets experienced, one of the worst years in history, with the aggregate bond market index down over 13% for the year. And so in combination, what this means is for a traditional, 60-40 stock bond retirement portfolio, for example, it was the worst year for decades, going well back beyond 2008, and a difficult year across the board for investors with no asset class to really hide in. And so while 2022 was a roller coaster ride marked by a downtrend throughout the year, it was positive to see the market take a positive upward trend in the fourth quarter, with the different stock market indices up quite significant amount from the September lows that we experienced during the year. Again, despite the uptrend in the fourth quarter, as well as a strong January, it was a very challenging year throughout in 2022. And it's unclear, going forward, whether we've reached a new uptrend or we're going to continue to see more turbulence in the months ahead. But one thing that we do feel strongly about, regardless of what direction the market goes in the short term, is we're likely going to see another year of big volatility, given all the headlines and different factors that are still unsettled and in play. Now, inflation has been the number one driving force in our view related to the big turbulence that we saw in the past year. And after, a decade plus of low inflation, we saw a lot of the stimulus that happened in 2020, 2021 in response to COVID manifest itself in the largest inflation we've seen since the 1970s, with June year-over-year inflation peaking at over 9%, a very, large, unsustainable number. Now, since then, we have seen inflation retreat, with the December inflation reading retracing down to 6.5% year over year. And so while this is good progress, that's still a very high number, much higher than the Fed targets. Now, despite this improvement in inflation, 2022 was a very difficult year, and Americans felt the pinch across the board. Whether it's housing, healthcare, transportation, food costs, we saw enormous inflation levels in every aspect of our day-to-day life. And while inflation does look like it has peaked, remember that inflation that we experienced last year has been baked in. And so pricing levels have reset. So even though we've seen inflation reduced to 6% year over year, the prior year of inflation levels have increased the floor. And so future inflation is off that higher level that we've now been forced to, basically stomach and live with going forward. The other big question is, while inflation does look like it has peaked, where does it settle? 6.5% is still a very high inflation number and nearly triple what the Fed is targeting. And so that begs the question whether we're going to see a nice smooth landing all the way back down to 2.5% inflation, or whether we're going to be sticky at 4 or 5% inflation for a while, which is going to force some hard decisions on the Fed. So in 2022, Americans saw several interest rate hikes in response to the inflation that we've been seeing. And, and more recently in November, the Fed hiked rates, 0.75%. In December, they hiked rates another 0.5%. And more recently in January, they did another rate hike of 0.25%. This marked a total of 4.5% of rate hikes in the past year plus, which is the fastest upward cycle in history. So going forward in 2023 and beyond, it's unclear where rate hikes go from here. The Fed has indicated that they're likely going to rate hike rates a couple more times to get to about a 5% level in the early months of 2023, and then hold that level there throughout the entire year. The markets, however, are expecting something a little bit different. They see the Fed hiking rates in the first couple months of the year to get to that 5% or so level that was noted. However, the market expects the Fed to dramatically start cutting rates in the back half of the year in response to an expected slowdown and recession in the economy. Now, time will tell where interest rates actually go from here, but we do believe we need to be prepared for, higher rates for longer if we do see stickier inflation than the market is expecting and pricing in, which of course would require the Fed to act tougher and hold on a higher rate level for a longer period of time. And so we will keep a vigilant eye on the federal interest rate movements and inflation ahead, because this is going to be a driving force in terms of what the economy and the markets do going forward. So as you know, bond prices have an inverse relationship with interest rates. And so traditionally when interest rates go up, as we saw last year, bond prices go down. And likewise, when interest rates go down, bond prices tend to go up. And so after a really difficult year in 2022 for bonds, the 30-year US Treasury bond, for example, had its worst return in a century, or is down 35%. And the aggregate bond fund, as noted on the prior slide, was down 13%. Both historically challenging years for bond investments. This does potentially set up where bonds can start acting like bonds again. And in addition to bonds having a higher interest rate yield now, with rate hikes having happened to date, they also may be able to provide ballast to an equity portfolio where if we do see a deeper recession and a retracement in equity performance, that might result in the Fed lowering interest rates, which can cause bond prices to go up in addition to the yield that they provide, providing support to equity markets. And so we do still feel we need to be cautious with long-term bond funds, given we do not know the rate and direction that interest rates will go in going forward. Not to mention, we currently have an inverted yield curve where short-term bonds are yielding a higher rate than longer-term bonds. But despite that, there is reason to believe that bonds can start working as they traditionally do in a retirement portfolio, which is a silver lining with the higher interest rates that we've experienced in the past year. And so as noted, a positive interest rates going up is we're now able to earn higher yield on our bond investments. And as you can see, a 5-year bond at the start of 2022 was yielding just over 1/3% a year. So a very paltry figure. In comparison, at the end of 2022, that same 5-year treasury bond was now yielding about 4% a year. So a much improved income yield, which provides a much better contribution to investment portfolios. And so our goal as financial professionals is not trying to predict the future, rather provide you with a solid financial plan that is designed to best weather whatever market environment that we're facing and achieve your own personal goals. In this high inflation environment that we're dealing with, one critical aspect is we need to earn yield on your excess cash to try to keep up with inflation. And so, at this point, while despite interest rates going up, money markets at the average bank per Barron's are still only paying about 0.25% a year. And 12-month CDs are not much better. And so the flip side of that is certain investments like T-bills, which model the Fed funds rate, are now yielding north of 4% a year. And those are very conservative investments. And so, one strong important aspect in the year ahead is that for any excess cash, you may have on top of your, baseline bank account amounts that you want to keep there at your fingertips, it's a good idea to make sure that we're earning that adequate 4% plus yield, which is now available for very conservative, safe investments. And so we'd probably say, if you have an excess of 20, 30, 40,000 more than you feel comfortable keeping in your bank account, but you still want invested very conservatively, there's an opportunity where we can look to get that invested in T-bills and earn that 4% plus per year, which can really move a needle on larger balances. And so, please contact us if this is something of interest for you or might be a fit with your own picture. So as we enter 2023, we stand by our mantra, likely another year to proceed with caution. And while we're coming off a challenging 2022, there's still a lot of factors at play in unsettled business that we're still dealing with in the economy. For example, where inflation goes from here, as well as interest rates, whether we do have a recession and how deep of a recession that is. It's broadly expected that we're going to have a recession in the coming year, though what's unclear is how long that lasts and how low we go. And so the direction of company profits, company earnings is a key aspect to look at going forward. Not to mention, we're still dealing with massive global uncertainty. with the Russia-Ukraine conflict really, charging on. And so that's another item we need to keep an eye on. And so as your advisor, we are committed to keeping you apprised of any changes in activity that could directly affect you and your unique situation going forward. For the 2023 outlook, there's some key aspects that investors should be looking at in the year ahead. The first of which, as we noted on the previous slides, is we need to be prepared for more interest rate hikes and possibly a sustained level in time of high interest rates. The cost of borrowing has therefore also increased. So in addition to making sure that we're earning adequate yield on your safe investments, it's also an important time to consolidate your higher yielding debt into possibly lower yielding rates. Additionally, make sure you have liquidity for short-term purchases and a reserve fund, which is really critical during difficult times like this. Review your income producing investments like we noted to make sure we're getting the adequate yield. And this is a critical time to practice patience and to remain focused on your personal long-term goals. I have a bullet here on the government debt limit drama. And so this is something that we're going to continue to see more and more in the headlines in the months ahead. And so, it's been a couple of years since we faced with this, but, as recently as 2019, it was essentially been an annual event in terms of, the upping of the debt limit. And, like prior years, we expect this likely is going to come down to the 11th hour as politicians on both sides of the aisle try to use this debt limit deadline for their own posturing for different policies. And so while it'll likely be last minute, we do expect that a deal is going to be in place. And we're likely going to continue to deal with this, song and dance every year going forward for the most part. If we do go down the highly unlikely path that we do not have a debt limit deal in place and that is not accomplished, it's important to note that the Treasury Department will still have enough cash flow to pay for their own debt, as well as entitlements such as Social Security and Medicare. So we do not see a risk that your Social Security benefit payments will not be made. On the other hand, it is true that other programs, agencies, and different entitlements will take substantial cuts. And so it can have a jarring impact in certain areas. But we do not expect either the debt payments made by the government or your own specific benefits to be impacted, even in the unlikely chance that we do not come to a deal ahead of the deadline. So as noted, talk of a potential recession remains front and center. And most analysts do expect that we are going to have a recession in the coming year. It is absolutely unclear, in terms of how long that recession is, when it happens, how deep it is, and time will tell. Economists typically have a really tough track record trying to predict these things and have, generally lagged the flipping of a coin, which kind of says how hard it is to predict the exact outcomes. And while we can try to foresee the future, again, no one can predict the exact length and depth of the potential recession. One positive, though, is that past performance does show that historically the US equity market returns after a recession have been quite strong. And if you look at, the 1 year and then 2 and 3 years after recession, they tend to outperform, especially that 2 to 3 year period, what typical stock market performance looks like. Furthermore, the latter half of recessions tend to be some of the best stock market periods. And so, much of this expected recession has been priced into the markets. Again, it's unclear how deep the recession is, which will absolutely impact, what the markets do from here. But, commonly a recession and coming out of a recession can be a strong period for the stock market. Furthermore, to take a little bit of a glass half full, view, despite all the concerns that we've noted on the prior slides, we just completed with this positive January what they call the seasonality trifecta. And technically, this can be a strong inference in terms of a return for the coming year. And so what this trifecta consists of is a positive Santa Claus rally in December, which we had, a positive first 5 days of the trading year, like we've experienced in 2023, and then a positive January, which we just capped with a 6% positive performance for the market. And so this trifecta has happened 31 times since 1950. And on average, the stock market has averaged an additional 12% in the latter 11 months of the year, totaling a 17% return on average in these years, which is well above the typical stock market performance. Furthermore, in the third year of a presidential cycle like we're in, the stock market has averaged 17%, again, well above average. And following a down year like last year that we experienced, the average stock market year is up 15%. And, so again, time will tell. Every circumstance is different, but this does point to some positives, which may, show we could very well have a positive market year this year. Furthermore, what's interesting with this seasonality trifecta that we notice is only 2 out of the 31 times since 1950 where we've had this combination has a market ended down. And in those 2 years, the market was down 6% and 13%. Even more interestingly is that there was 4 times where the seasonality combination crossed over with a recession. And all 4 times, as bracketed in the boxes on this chart, the stock market had very high performance, averaging 30% in those years. And so by no means is seasonality flawless. There's a lot of concerns for us to kind of navigate through in the coming year. But this is a fun fact that shows even when times feel dire and sentiment is negative, there's a lot of aspects we can point to that might mean this could be a very positive year. And so we'll see what happens in the coming months. And I'd say to add on to that, we do see some really good value in certain asset classes, including small cap stocks, international stocks. And so there is a possibility, especially certain areas can have a solid year in 2023. So time will tell. As a recap from our presentation, here are some key takeaways that we hit on. One, this current bear market looks like it could continue for a while. And so again, just prepare for some more volatility, keep on the seatbelts. But remember that bear markets are part of the investment experience. They do come to an end. We are over a year into this one. And, so good chance we're getting closer to the end of the tunnel than the start. And furthermore, the bull markets last for much longer and are much more prevalent. And so this tide will turn at some point as well. Remember, interest rates are still on the rise. So refocusing and revamping your budget now, as well as making sure you're earning an adequate amount on your interest-bearing investments is very critical. And more than anything, these are difficult times, and we are here to help our clients create well-crafted, customized plans unique to your own situation and goals, and take into consideration how each client, feels and reacts to these ups and downs. And so we consider many variables, including time horizon, tax implication, liquidity needs, risk tolerance, overall personal objectives. And so please remember, we are here for you. If you'd like to revisit your financial plan with us or discuss any concerns or ideas, please do not hesitate to call our office or bring them up during your next scheduled meeting with us. Likewise, one of our goals this year is to continue to help others. So please feel comfortable letting us know the names of anyone that you feel could benefit from our services or information. These are uncertain times, and we are here to help you manage that uncertainty. And we are here for your colleagues, friends, loved one as well. So please don't hesitate to contact us or put us in touch. Something that tends to work well is an introduction email, where you could email the person you're thinking of that may benefit from meeting with us and include us there. So that's a good way to connect us. Also, feel free to pass on our information. Likewise, send us the information of anyone that wants us to reach out, and we'd be happy to connect with them. We're excited to announce that we are bringing back our Client Ambassador Program, which was on a bit of a hiatus following COVID. And what this program is as a thank you for introducing us to someone that could benefit from our services that we meet with, or bringing someone to one of our educational events throughout the year, likewise adding some folks to our communication list. We're going to be doing a thank you event this spring as a benefit to you. And so again, we appreciate you supporting our growth. We are here to help you as well as the ones that you care about. And thank you again for watching our economic update video. Please contact our office if you have any questions.